Hi everyone, welcome to our first lecture in corporate finance. So in this lecture video, I will basically give you an introduction to this course and then talk about the topic of time value of money. So let me first give you an introduction. Our objective today is to briefly go over what corporate finance is. And we can begin our understanding of corporate finance by first defining what these two words mean. Namely, we need to find a way to define what a corporation is, and also we need to also find a way to define what finance is. So the former can be a bit philosophical. A corporation can be defined in many ways. From an accountant's perspective, for example, a corporation is something that has assets and liabilities, or more precisely, a balance sheet. However, in this course, we want to eventually take a more generalized view. A corporation can essentially be viewed as a collection of contracts, specifically contracts on how to share profits, losses, and control rights of the firm. And so why is sharing important, you might ask? Answering this question leads us to the definition of what finance really is. So by the end of this course, I hope to convince all of you that finance is really about designing contracts to share risk among different investors in order to fundraise profitable projects. So this goes beyond what you might believe what a corporation is. This can also be applied to households and individual decision making, not necessarily from the corporate, the managers of a corporation's perspective. So you might be asking, why does risk sharing occur at all? All right, so you have to understand that different investors have different risk preferences. And as you can imagine, investors with lower risk tolerance can trade away that risk for something less risky, such as a guaranteed investment return. A market, therefore, permits the creation and trading of such financial contracts or securities and allow risk to be efficiently allocated so that corporations, which can include individuals and households, to pursue profitable projects or investments. Therefore, our primary objective in this course is to introduce to you a flexible valuation framework that establishes a relationship between risk and return. The basic idea is that once we understand how risk is incorporated into our valuation framework, evaluating costs and benefits of financial decisions is extremely straightforward. Then our objective is clear. We want to maximize financial value or the net benefits from the perspective of investors or managers or head of households. Okay? Before diving into the mathematical modeling, let us first get a sense of what kind of financial decisions are typically made by corporations and households. Okay, so in slide 1, I posed the question, what are some examples of financial decisions that firms make? And so let's come up with a list together, okay? So first thing first, our objective, to reiterate, is to find ways to maximize or improve or increase financial values. So I'm going to write financial value in the center here. And then I'm going to draw out branches of different decisions that a corporation might have to make in order to improve financial value of the firm. All right, so first things first, you might imagine that all corporations make some sort of investments in order to get some return. And so number one, investments is an important decision-making topic. Should a company, for example, buy new factories or machines or intellectual property? And so you should ask yourself how one should go about making such decisions given future uncertainty about the value of such assets. And so once we introduce this framework, you should be able to factor in these risks into our model and therefore be able to weigh the costs and benefits of certain investments, comparing return on investments between different projects. Second example of financial decision is whether or not a company decides to engage in strategic partnerships. For example, should a company endeavor to produce a particular product itself, or should it form a partnership with a competitor? Each of these decisions have benefits and costs, and we need some sort of framework, again, to value these costs and benefits and compare these net benefits across different decisions. Okay, again, how would you go about making such a decision? Are there risks different, and how do we evaluate such costs and benefits? A third example is an important topic in corporate finance called capital structure decisions. So capital structure refers to how the company is financed and how it generates money so that it can engage in its day-to-day operations. Okay, so the question I pose to you is, how should a company be financed or owned? Firms basically have two types of stakeholders, stockholders and bondholders. How much of each of these type of stakeholders should this company engage in? It depends, okay? There are certain costs associated for having too many bondholders, such as bankruptcy costs. There may be a problem when you have too many stockholders. Perhaps you are taking excessive risks because, again, stockholders have all the upside, but they have none of the downside. All right, so again, to reiterate, once we realize that we have this decision to make, what are the costs and benefits of each type of stakeholders? This is actually a fundamental question in corporate finance, which we will actually get to by the end of this course. Okay, so we won't talk about this early on, but we will circle back eventually. A fourth example of something that a firm has to make a decision on is its risk management. Okay, so for example, how can a company limit its exposure to only a specific kind of risk? Take airline companies. If they don't want to be exposed to oil price fluctuations, can they buy some sort of contract that does so? Of course, this kind of contract is called an insurance contract or a hedging contract, right? How do you determine the price of such insurance contract? Similarly, we need to be able to quantify the costs and benefits and make sure the costs do not exceed the benefits from the airline company's perspective. All right. A fifth topic deals with corporate structure or its management structure of the firm. So from the perspective of the manager of the firm, or from let's say, the shareholders of the firm, how do you incentivize your managers of a company so that you can limit the risk of their slacking off, for example, or not doing their job? Can we design and value compensation contracts to achieve the performance target of the firm? Okay, so once we have a valuation framework that I will start to introduce to you today, we can then basically calculate the costs and benefits of these contracts and see if the net benefits exceeds the costs, or the salary and compensation of these managers. And lastly, we have the final topic of human capital decisions. So similar to corporate structure, human capital refers mainly towards your employees of the company. Like, what are the costs and benefits of hiring skilled workers? Again, we need to be able to design and value employee compensation so that they are productive. Okay, so these are examples of financial decisions made by the firms. We can similarly outline a list of financial decisions for the household. And as you can see, the decisions are quite similar. And again, once we have a framework to evaluate risk and incorporate that in our cost and benefit analysis, we should be able to make better financial decisions. Okay? All right, so to reiterate again, our objective is to maximize financial value from the perspective of the household. And one major decision that you might engage in is whether or not you should buy or rent a house or a car, right, or an apartment. You can think of this like making investments from the corporation's perspective. Similarly, you have to figure out what are the costs and benefits of buying or renting a house or a car. Should you rent or buy? And there are different risks associated with each of these actions, right? If you buy, you might have appreciation of the asset, or if you rent, it's possible that the price of buying the asset goes down, and actually you don't have to lock in that rental rate for a year or 2 years or whatnot, which is costly. All right, so it really depends on how you quantify those risks and how you factor that into your cost and benefits analysis. Second, from a house perspective, you also have some degree of risk management tasks as well. So let's just talk about insurance. Insurance can be referring to health insurance. It can be talking about car insurance, life insurance, all these just contracts that helps you hedge against the downside costs, right? But you may have to pay a fixed premium for a fixed amount of time, right? So the question you might have to ask yourself is, how do insurance companies determine how much your insurance premiums are from the perspective of the insurance company, and how much should you pay out? Again, how much should, for example, if you get into an accident, how much should that total payout be to cover your costs? And how much should you be willing to pay for such a contract, right? These are all important questions where there's risks, right? Different, depending on which side of you are on the contract, you have different risk. And how do we incorporate that risk into our cost-benefit analysis? Third, which is related to buying a house actually, are mortgages, right? So mortgages, you can think of it as debt issuance. You are an individual, a company of one, and you need to issue debt so that you can make investments. So in this case, mortgages, you're actually issuing a bond. You are paying out, a flexible or fixed interest rate, but you get the money to buy a house, and that house may appreciate or depreciate in value, but that's the kind of risk you have to figure out if it's worth it at the end of the day. So should you use for example, the kind of questions you may have to confront is, should you use a fixed or flexible mortgage rate? And at the end of the day, what are the risks for each of these contracts? And we'll talk about that example later on in a couple of weeks. All right, so quickly, let's go over the last two examples here. We can talk about retirement and education planning. In this kind of decision making, we're really talking about opportunity costs of whether or not you should save or whether or not you should consume something today, right? So if you save, you earn a certain interest rate, you can calculate the benefits or the so-called maybe an opportunity cost of saving. And if you consume something today, you have costs and benefits for each of these decisions, and you can compare their net benefits and therefore make the best financial decision possible to, again, increase whether or not your objective is to increase as much financial value as possible. Similarly, that is the same objective for your own portfolio of financial assets. So portfolio management is another decision, another topic that you have to engage in some sort of financial decision making. What assets should you invest in? It depends on your time horizon. If you're in very early, you might want to buy risky stocks. But if you're like me, you're getting older, you might invest in less risky stocks and less growth and more dividend payouts. Okay. Again, it depends on your risk tolerance, and you have to evaluate these risks from a cost-benefit analysis and find a way to incorporate this risk into your evaluation model. Okay, so hopefully these examples gives you a sense of what kind of financial decision makings we are going to think about in this course, and how what kind of framework or model we need to build in order to start evaluating these financial decisions. Okay, so in this slide, in slide 3, I asked you, how should firms or households go about making those decisions? So the overall message here is that we need a way to evaluate the costs and benefits of each financial decisions, regardless if you are a household or a firm. And the objective for both the household and the firm, therefore, is to create as much financial value or benefits as you can. From the firm's perspective, you should be maximizing shareholder value. From the household's perspective, you should be maximizing your utility or happiness. So let me reiterate what I just said. Our objective should always be creating financial value. And we need, once we have a list of options, we always choose the one that creates the most value. We identify the one that creates most value. Okay, so from the firm's perspective, typically we talk about, when we talk about creating financial value, we're talking about maximizing shareholder value. But if we are the household, you're basically a shareholder of one, or your husband and your wife. We're just talking about maximizing utility, right? Or your happiness. So it's not just the value you get today, but it's also your expected future value that you might get tomorrow, in 5 years, and 10 years. And we're going to introduce to you a model or framework to factor in these future value and be able to compare these future values in the present. Okay? Okay, so our learning objective of this course first is to introduce to you a framework that allows you to make financial decisions, whether or not you are a manager of a firm or a head of household. And we want to accomplish this by modeling financial decision in terms of cash flows. Okay, that's the key intuition here. We're trying to model everything in terms of cash flows, and that may have different timing and different risks. And we're going to find a way to map these cash flows to their corresponding risk and also their time value, and try to bring them back, make them comparable at time zero or today. Okay, and we will talk about in this course, we will also talk about common securities issued by firms, such as stocks and bonds. Okay, and lastly, we will rigorously define and measure financial risk and so that we can optimally structure portfolios and investments to take into account of that risk. Okay, in page 5, this is just to emphasize that this course, despite my introduction, may seem overly qualitative, but I assure you that this course has a lot of deep quantitative results. Okay, but an intuition gives you much more rigorous understanding of rather than just blindly using formulas. Okay, so the quantitative aspect of this course, you will learn how to calculate the fair value of a price of a stock and bond. Using this model, you should be able to actually value any new project from the firm or the household's perspective. And we will also talk about, once we are able to quantify risk, we can start talking about how to optimally structure our investment portfolio. Okay? But of course, intuition is important, so I will try to give you as much examples as possible so that you have also a qualitative understanding of the mathematics that I'm going to introduce. Okay, so success in this course requires mastery, not only the mathematics, which is not too difficult at the most difficult topic that we're going to apply is probably multivariate calculus, but that's you don't even actually need to know that for sure. All you really need to do is understand the intuition of this derivation, and I think you're good to go. Okay? All right, so our learning objective in this lecture is to understand how to compare cash flows that occur at different points in time. And so what we're going to do is we're going to talk about future and present value. So these are two terms that I'm going to use fairly often. Basically, present value is the value of something that's you get today. So if I paid you $5 today, that's the present value. Its present value is $5. But if a future value of something is what you will get, 1 year from today, or 2 years from today, or 10 years from today. Okay, but we have to make these present value and future value comparable, and that requires either compounding or discounting. So compounding just means using the opportunity cost or the interest rate, that you can get from delaying using this amount of money and bring it into the future, so that we can make things comparable in the future. Or we can bring the future value to the present by discounting it using some sort of opportunity cost, which is we're going to use interest rates to proxy for opportunity cost. Okay, so to reiterate, to give you just to give you a general overview, future value is the amount of money that you get sometime in the future. Present value is the amount of money you get today. But in order to make these cash flows comparable, we either have to make them all into the future by using compounding. So that's basically, okay, I'm putting the money aside, letting it grow for a few years, and bring the present value into the future and making those cash flows comparable. Alternatively, you can also bring the future value back to the present, and that requires, again, using that same discount rate and discounting it back to time 0, so that you can make those cash flows comparable again. Okay, of course, I will introduce these topics slowly over the next few in this video. Okay, and all right. Secondly, I will talk about shortcuts to the present value. So I'll talk about special cases of infinite cash flow periods called perpetuities, and I'll talk about finite cash flow periods called annuities as we progress through today's lecture. And then I'll talk about net present value, which basically is comparing the costs and benefits of certain cash flows. So as you imagine, you can have inflow of cash, but you can also have an outflow of cash. You may be paying something, you may also be receiving something. But once we bring these cash flows to a comparable period, either to the present or to the future, we can evaluate its so-called net present value, or net benefits, right, after adjusting for the costs. All right, and then last 2 points, I will talk about, I'll review certain compounding formulas that you may have seen in your accounting or finance class as an undergraduate, and then I'll go over how to convert interest rates depending on different compounding frequencies. Okay, so again, these are just technical things that I hope to bring everyone on the same page. So if you have no background, don't worry. I will make sure that everyone is on the same page by the end of this lecture. Okay, so let's start our topic of the time value of money with our discussion of future and present value. Okay. So in this slide, I posed the question: is $1 worth today? Is $1 today worth $1 a year from now? And the obvious answer is no. And the reason is because you can do many things with that dollar between now and 1 year from today. And in finance, what we typically use to represent this alternative, the next best alternative in using something, is through interest rates. Okay? So let me reiterate by writing this down. So in this class, we're going to be using interest rates as a way to map present value, PV, to future value. FV. Okay, so just to give you a heads up, I'm going to use PV and FV to represent present value and future value, just to reduce the writing that I have to do. Okay, so interest rates is, I'm going to try to explain to you in several different ways. So first way to explain what interest rates are. Interest rates, again, is your opportunity cost of consuming something today or using that money for something else. For example, if I want to, let's say I had plans to use this dollar to buy a soda, okay? It's going to cost me a soda, but that's not the full cost of buying the soda. The full cost is actually that $1 plus my opportunity cost. And that opportunity cost is the next best alternative that I can use with my dollar. And typically in finance, we like to use interest rates to represent this next best alternative. So my next best alternative to using that dollar to buy that soda is is the interest that I would receive from keeping that dollar in the bank. Okay? That's one way to look at it. Another way to look at interest rates is the amount of money, the amount of interest that you would receive so that you'll be willing to part away from that dollar today and leave it in the bank to generate income, right? It's basically saying the same thing. It is your next best alternative, but what I just said is that interest rates are the amount of money that you're willing to part that dollar today so that you get more in the future. Okay, some amount in the future. Okay. So let's talk about this example. Let me give you an example here. Okay, so let me write this down on the slide here. Example. If I do not spend $1, I will get 5%. Okay? So again, 5% is the next best alternative to using that dollar for whatever I'm going to use, or that's the amount of money that I'm willing to part with that dollar so that I get some amount in the future that's larger than $1. So how do we use interest rates to move from the present value to the future value, or from the future value back to the present value? So let's start with the more obvious, the more intuitive path is from present value to future value. So let me draw a timeline here. 0. Let's say 0's today, and 1 is 1 year from today, and so forth. So if today I received $1, and 5% is 5% per annum. So 1 year, if I decide not to use that $1, I am basically putting that $1 in the bank and generating 5% from that $1. So at the end of 1 year, I should get 1 times 1 plus 5%, right? If I want to go out 2 years, I simply reinvest that money in the bank, right? So 1 times 1 plus 5%, and then I will compound it again by 1 plus 5%. So in 2 years, I should get 1 plus 5% to the second power. All right, so this is our way to utilize interest rates to bring the present value of something into the future. So if today is time 0, if I want to move $1 into the future, I simply compound it by 1 plus 5%. If I want to move my $1 today into 2 years into the future, I simply compound $1 times 1 plus 5% twice. So that's why there's a square. All right, so fairly simple, right? I'm simply, in order to move money from today into the future, I'm simply looking at some interest rate that represents my next best alternative. If I want, and there, or the amount of interest rate that I'm willing to part with my dollar today. That's another way of saying it. And if I leave that dollar in for 1 year, I'm basically moving that value of $1 into the future. Okay. Same things for 2 years, 3 years. You can move that into infinity if you want. All right. So how do we move from the future value to the present value? again, let me draw a timeline here. So 0 stands for today, 1 stands for 1 year from today, 2 years from today, and so forth. So if I have, let's say, let me write 3 years here too. So if in the future I know I will get, let's say I will pay 1 plus 5% cubed. Okay, this is just to make notation easier to read. If I have 3, if in year 3 I will receive 1 over 1 plus 5% cubed in order to move it back to the present value, I simply, if I know I'm going to be paid 1 plus 5% in the future, cubed, then in order to move from 3 years to time 0, I simply discount it by 1 plus 5% 3 times to get a value of 1, right? Same thing for future value of 1 plus 5% squared. I simply have to discount it 2 years to get $1 today. And similarly for 1 plus 5% in time 1, right? So let me reiterate again. So if I want to move from 3 years to time 0, I simply take 1 plus 5% cubed, and I have to discount it for every period that it takes to go to time 0. So that's 1 plus 5% cubed. That's going to give me 1 at time 0. Okay? So to reiterate, if I want to move from present value to future value, I simply compound my present value until I reach the year that I want to get to get a future value. And I do this by multiplying by 1 plus the interest rate. Conversely, if I want to move from future value to present value, I take that amount in the future and I have to discount it by 1 plus 5% or divide by 1 plus 5% to the cubed. And that number, to some exponential. So that exponential term or exponent term represents the number of periods that I have to move back to time 0 in order to get my present value. Okay? Okay, so let's move on to examples, just to make sure we are on the same page. So on page 8, I give you an example for calculating the future value. In this page, the setup is suppose you deposit $10,000 in a savings account that pays 6% interest per year, compounded annually. What will be the balance of the account in 1 year, in 2 years, in 3 years, and n years? So all we have to do is come up with the expression here to answer these questions. There is no actual you can calculate them out if you want, but all I'm looking for is just to, again, present to you the expression so that it's more intuitive. Okay, so let's write out a timeline first. Okay, so for 1 year, let's just do 1 year for now. So we have a future value for 1 year, and we know that we deposited a present value of $10,000, and we know that in order to get the future value of 1 year, we simply multiply it or compound it by 1 plus 6%, right? And that's how you would get the future value for 1 year. And it should be straightforward to get the future value for 2 years. It's simply the present value of, so this is present value of $10,000 times 1 plus 6% squared. And for the general n future value, we simply have to take that $10,000 and compound it by 6% to the nth power. Okay, so fairly straightforward, I hope. And just to reiterate, for this problem, we're moving from present value to future value. Okay. For slide 9, I gave you another example. We're trying to calculate the present value from a single cash flow in 1 year. So in 1 year, you would like to have $200,000 for the down payment of a new house. You have access to a savings account that pays 2% interest. How much do you need to put in the savings account today to make sure you have enough for the down payment in 1 year? Okay, so today in this question we are given the future value. So we need $200,000 in 1 year. We are given the interest rate, and we are trying to solve for the present value. So let me write out the formula you should be thinking about first, and then I'll fill in, and I'll substitute them with actual values that's presented in this question. Okay, so just 1 year, so just 1 plus r to the 1th power. We are told that the interest rate is 2%, and we are also told that the future value has to be $200,000. All right, so to calculate the present value, we simply take the $200,000 and we divide that by 1.02, or discounting the $200,000 by 2%. Okay, so the formula for the general nth year future value, we can write it in the following way. Okay, assuming interest rates are constant and we are given the future value of any period, right? We can solve for how much we need to have today to finance our down payment for that house. Okay, so an extension to the previous question, consider the example that you decided to give yourself some more time to save. How much do you need to put in the savings account today to make sure that you have enough for the down payment of $200,000 in 5 years? So using that formula that I just presented. So recall the formula I gave you in the previous slide. To solve for the 5-year case, we discount $200,000 by 2%, but that's compounded 5 years. Okay, or just dividing $200,000 by 1 plus 2% to the 5th power. All right, so the math should be very simple, right? These are just algebra stuff that you learn middle school and high school, but the intuition is important, right? We're basically trying to find a way, we're trying to introduce, again, the framework to map cash flows of different periods, essentially to a period in which we can compare that cash flow across different outflows and inflows, right? In this case, we're simply talking about inflow of cash, right, to meet certain conditions, right? In this case, we're talking about savings money so that we can reach a target of $200,000 to make a down payment for a house, all right? Okay, so what I have presented to you so far is the present value of C dollars in N years at an interest rate of C. Of C dollars in N years, so that's C dollars and 1 plus R N, right? Or in other words, you can write this as PV times 1 plus RN equal to C equal to future value. All right, so that's what I presented you so far. And what I ask you in this slide is, can you think of other ways of asking the same questions, perhaps in a more real-world term? And I'll give you 3 ways to think about this formula. Okay. Again, math is simple, but intuition is important, especially when we have to think about in terms of financial decision making or asset pricing frameworks. Okay. So number 1, another way of saying this is the money you need today to grow so that you will have equivalence, or equivalence here is in terms of future value, in n years. Right? So the money you need to grow in 10 years is, it's like a savings problem. And once you have interest rates, it's very easy to calculate how much you need to save today, or put in the bank account today, so that you have enough to reach that target in the future. All right, second way of expressing this in more real-world terms is, how much money do you need today so that you have exactly FV dollars in n years, given that you can lend it at R% a year. So number 2 presents this formula in a way of borrowing and lending, right? You're lending money to somebody, or somebody's borrowing money from you at a certain interest rate, so that you can be paid a fixed amount sometime in the future, right? That fixed amount is the future value. And lastly, we can think about this question in terms of bond pricing, right? For example, what is the price of a security or contract that promises to pay, let me continue this over here, PV1 plus R to the nth power in n years. Okay, so this is more precisely like a bond payment, right? The present value is, as you will see, is equal to the price. It's another way of saying the price of something. A bond pays interest payments year after year, and you can accumulate that interest, and once you discount it back to time 0, that's the value of the bond, and that is the price. All right, so these are some things to think about, and as we approach next week and the following week, we'll see that this net present value or time value of money framework can be applied not only to bonds but also securities. But we just have to find a way to incorporate the risk, right? This risk differentials between bonds and stock, mainly the cash flow for bonds is almost guaranteed when we generally evaluate bonds. But stocks, the price, the price, their cash flows are risky, right? Their dividend payments depend, it's a function of their future revenue or profits or earnings more precisely. But how do we actually incorporate that risky cash flow directly into this time value of money framework? And the hint, the preview here is that we're going to capture this through the interest rate. Okay, the idea here is that interest rates, as I said before, is a proxy for opportunity cost, or the amount of money you're willing to part today. okay, so that you can make some interest sometime in the future. As you can imagine, risky assets require a higher return, right? And otherwise, there's no reason why you should part your money given the extra risk. You might as well just put it in a bond. All right, that's the intuition, and we will eventually get to that point where we develop a model to come up with a proper interest rate or discount rate to discount stocks. For bond, it's much easier. We're just talking about risk-free cash flow payments, and so interest rates that's quoted by, for example, the Federal Reserve is good enough for us. Okay, so more intuition here. So as I already presented in the previous slide, in slide 12, I gave you the present value to future value formula. And again, the link between present value and future value is through interest rates. And depending on the number of periods between the future value and the present value, that's the amount that you have to compound or discount. So let me try to give you more intuition by give you visual representations of present value calculations or future value calculations. We typically want to bring things into the present, so we will write t equals time equals 0 to represent today, and that's where we usually indicate our present value. And let's suppose that each of these tick marks represents 1 year apart. Okay, blah blah. And whenever we want to move from the present into the future, we need to compound by our opportunity cost up to the point in which we want to calculate the future value, right? So if we want to move from 0 to 3, we would compound 3 times, or 1 times r% to the power of n, right? And if we want to move from 3 years back to time 0, we have to discount at a specific interest rate, right? So this is future value calculation. This is present value calculation. And when we want to bring things from the future into the present, we need to discount. Discounting 3 times. All right, let's move on to slide 13, which is an example of using these present value of multiple cash flows. Suppose you decide to open a 529 college savings account. So this is a type of savings account that people typically can open and receive tax benefits in the US for your newborn daughter, for example. To start your planning, you make the following assumptions. Your daughter will start college exactly 18 years from the day you were opening the account. Tuition and expenses will be $100,000. Okay, this is not unusual. College is quite expensive, especially if you go to private schools in the U.S. Okay, so suppose tuition and expenses over 4 years is going to be, it's going to be $100,000 a year for 4 years, and they are payable at the start of each school year. Okay, so that means that we must have $100K at the beginning of each year to service, books, tuition, housing, and so forth. All right. Suppose our 529 vendor, or in this case, usually bank, offers an investment option that pays 6% in interest guaranteed for the life of the account. Okay, so let's start first by drawing a timeline to get a sense of what needs to occur every period, so that we understand the cash flow. The cash flows. All right, so let's draw a timeline here. Again, present is t equals 0, and because your daughter is born at t equals 0, we should start thinking about the cash flows 18 years from today. So at time 18, she will go to college, but as stated in this slide, we need 100K at the beginning of the year for 4 years starting at the age of 18. So we should have an outflow of cash of 100K starting 18 years from today. At age 19, there's another 100K outflow. Age 20, another 100K outflow. And age 21, I think we will have another minus 100K. And then hopefully she will finish college. Okay, so what we need to figure out is how much we need today so that we can have this outflow of 100K each year for 4 years, starting 18 years into the future. So it's quite simple, right? We have future values of cash outflow. We need to discount them back to time 0 to figure out how much we need to have today so that we can have enough money at a 6% interest rate to service those outflows in the future. Okay, so it's fairly simple, right? Each of those 100Ks, we discount it back to time 0. So that's 1 plus 6% and 18 years plus 100K, 1 plus 6%, 19 years plus 100, 1 plus 6%, 20 years, and lastly 100K divided by 1 plus 6%, 21 years. And we get a final amount of 128K. Okay, so that means we need 128K today. And once we put that in the bank, whatever our 529 vendor is, that will pay 6% per year. By age 18, we will have 100K available for the next 4 years to pay off, tuition, books, housing, whatever, right? Another way of saying this is that the price of a bond that pays out 100K for 4 years, 18 years from today, is valued at $128,000, right? Okay, so that's an example of using present value method to evaluate cash flows that occur sometime in the future for a fixed amount of time. All right, so that's what slide 14 was about. So to summarize, we needed 100K in years. We needed 100K at the beginning of each year, starting in 18 years all the way to 21 years. We will, once we allocate a lump sum into the bank account at time 0, we will earn an interest rate at 6%. And we calculated that present value by using the present value, future value formula, right? Okay, so an extension of this problem is that suppose in the previous question we only had one lump sum payment or lump sum deposit at time 0, but suppose we are allowed to deposit a fixed amount for 10 years. So that gave us flexibility. How much do we need to deposit each year? So that's an easy calculation actually. So once we have the present value, we can simply map this present value into future values quite easily, right? Especially given that this fixed amount is known, right? We know it's a constant for 10 years. And so in order to map this present value to future value, we simply have to use the formula, but now rewrite it such that our C is constant for 10 years, right? So let me write the expression so that'll be much clearer. So in the previous question, we already know the present value, but we simply want to readjust this present value so that it's fixed payments for 10 years. So we just take that 128K that we calculated and we repackage it as 10 fixed payments, right? So let's say it's X fixed payment today plus X fixed payment sometime in the future. So that means we need to discount it by 6% plus x plus divided by 1.06 to the second power, since it's 2 years later, all the way to x over 1 plus 0.6 to the ninth power, right? So 10 periods of fixed payments, which is what we want to solve. We want to solve for this x, and all you have to do is factor out that x and solve for x. And you should get an x value of 17K. So as you can see, once you know the present value, it's very easy to rewrite this, repackage this as another type of security, right? Now we're thinking this 128K, this price of 128K to be a 10-year bond, essentially, that pays out 10 times, including today. And we already know the interest rate of 6%, so it's very easy to make that conversion. Okay, so hopefully based on this example, you realize that it's actually very, once you understand this framework, it's very flexible and easy to convert different types of things to another, different types of securities to another type of security. If we have a bond that pays, for example, not starting, pays, let's say a bond pays interest not starting today, but 10 years from today, we know that this asset is therefore comparable to another type of security that has present value that's the same, right? It doesn't, but its cash flow doesn't have to take place at the same time as this bond. It doesn't have to start 18 years from today. It can start from tomorrow. But at the end of the day, what's relevant is actually its present value. Okay, so of course we only talked about one source of cash flow, right? In this case, we have an outflow of expense that we need to make to help your daughter pay for college expenses. But you of course you can actually have multiple sources of expenses, and it's very easy to calculate the so-called net present value by simply taking the discount, by discounting these expenses back to time zero and adding them all, adding the present value all up. Okay, so let me give you an example here. From the household's perspective, you can have many sources of expenses. And I'm going to write in the columns the time. So suppose t equals 0 is today, t equals 1 is 1 year from today, and so forth, all the way to, let's say, t equals 12, so 12 years. And we can have many types of expenses, not only for tuition. Let's for example, use a cell phone bill. We can have rent. We can have a positive inflow. Suppose we have post-tax income. All right, that's inflow of cash. And let's say we have, food. So cell phones, you may have to pay, for example, 300 Hong Kong dollars a month. All right, that's not too extraordinary. And at the end of 12 years, you have, so sorry, let's say this is months, okay? I think that makes more sense, months. Okay, so t equals 0 is this month, t equals 1 is the following month, t equals 2 months ahead, so $300 per month. Rent, we have, let's say, $10,000 Hong Kong dollars per month. And we have post-tax income. Suppose you make $40,000 a month. Okay. Realize that this is positive. It's not a negative. And for food, suppose we spend $10,000 a month as well. So that's why it's a minus sign. All right, net. So sorry, I forgot there's another column here. Let's suppose it's the same. $10,000 plus $40,000, and this is minus $10,000. Okay, and so total, we have 19.7K, 19.7K, 19.7K. So this is positive. So that means there's some savings here. 19.7K. So once we net all the cash flows per period, it should be very easy to calculate the present value or the net present value because we are aggregating across different cash flows. So the MPV is simply the future value of time 0, which is just 19.7K, plus the future value 1 plus R, 1 year from today, plus the future value 2 years from today, and discounting it at 2 years, and all the way to future value 12, right? 1 plus R 12. Okay, so just the only thing you may have to think about is what should R be. So remember, the interest rate so far that I've given to you is annualized, so that's per annum. And if it's given per annum, and we're dealing with month, you should divide that interest rate by 12. So I'll get to interest rate conversion later in this lecture. Okay, so in slide 17, this is basically presenting to you what should be already intuitive to you based on the examples already, right? We talked about bond pricing in terms of cash flows already, and we can actually compare cash flows of different periods with each other so long as we have the present value. And so what I've given to you is basically a form of the law of one price, right? So as you can imagine, if I calculate the present value of something and that's different than the price, then there is a violation of law of one price. That means that I can actually, buy low and sell high, and that will give me what's called arbitrage profits, right? So in other words, if there is some degree of mispricing or the violation of law of one price, then you can profit off of this by buying low and selling high. Okay. So let me give you a little bit more intuition. So this infinity sign means growing to future infinity. Sorry, forever. Let me rewrite that. I think forever. And CN is cash flow each period N, and R is interest rates. Okay. So suppose we know the cash flow of a certain asset or financial contract, and we come up with a present value, but we observe that in the markets, perhaps that a similar type of security or an exact kind of security has a present value that's different than what you calculate. Okay, for the same cash flows. Then by definition there is arbitrage, because same types of cash flow structure, but the prices are different. So what you can do is you can obviously profit from this, right? You can buy low, sell high. I mean, buy PV1 and then sell at PV2. Okay, so this should be quite obvious, right? All right, so that's our introduction into this present value or law of one price asset pricing formula, and we're going to be using this extensively, right? Now we're going to first go into bond pricing, and then we'll go into stock pricing, and then we'll move on to refining interest rates so that we can fully capture the appropriate risk to discount these cash flows. Okay. But for the rest of this course or this topic, I'm going to talk about different formulas of this formula. this formula here. Different expressions of this formula for special conditions. Okay. More precisely, I'm going to be talking about perpetuities, which are finite payments of cash flows for a set fixed period, and then I'm going to talk about annuities, which perpetuities are cash flows that go out to infinity. So yes, the infinity sign is going to be there. There's a special formula for that, and then I'm going to talk about annuities, which are fixed payments for a fixed period of time. Okay, we get special formulas, and deriving these expressions will help you with your calculations, right? You don't have to actually literally calculate to infinity. You can just simply use these formulas that I give you in your homework and on your exams and so forth, right? All right, perpetuities and annuities. So let's reiterate these definitions that I just gave you already. Perpetuity is a stream of equal cash flows that occur at regular intervals for all time. So that means that it may not have to start today, but start sometime from 0 to some n. N can be any time in the future. But the cash flow payments, once it starts, will go on forever. That's what a perpetuity is. And we can actually come up with a simplified expression for that. And once you have that expression, you know how to price perpetuities. Annuities, as I said already, is a stream of equal cash flows that occur at regular intervals over a specified time period. So for example, it can start today, it can start at any point in time n, but once it starts, it will stop sometime in the future. It can go on for 10 years, for example, starting from n, 20 years from n, or it can go up from n to 100 years if you want. All right, the last two definitions are just modifications of perpetuity and annuity. So growing perpetuity or annuity, that just means that it's not a fixed cash flow every period. There's actually another growth term, which we allow the constant to change period after period. Okay, so the last term, delayed perpetuity or annuity, just means that we're not starting from time 0. We may be shifting it out into the future at year 10. Okay, so let me give you visual representations of these terms. So for perpetuity, we have t equals 0, but we have cash outflow or inflow, 1 period out, 2 period out, all the way to infinity. Okay, so let's say it's positive c, right, all the way to infinity. On the other hand, an annuity will stop sometime in the future. So in this timeline that I wrote, same thing as above, it will stop at, for example, time k. So let's say we will receive cash flow C 1 year from today, 2 years from today, 3 years from today, and our final C is at time k. Growing perpetuity or annuity is same thing, but now we allow our C to grow every period as well. So let me give you an example. Let's say just for annuity, perpetuity, again, the difference is just there's a cutoff. It doesn't go on forever, but let me explain the growth part. So instead of getting C every year, we start getting something else in the second year. Okay, so let's say it grows by Y% after the first year. Okay, so in the third year, you would get plus C 1 plus Y to the second. All right, so if it's a perpetuity, it goes on forever, so that's an infinity sign. But if it's an annuity, it stops at k. All right, a delayed perpetuity annuity, as I explained, is simply just a shift in the timeline. So t equals 0 today, but the cash flow payments or outflow of cash flow doesn't start until, for example, maybe 11 years out. So let's say this is 10 year, and then this is 11. You get C payments. Okay. And depending if it's a perpetuity or annuity, it goes on forever or it stops at K. All right. So important thing to note: at time 10, we can calculate the present value of this payment, and to bring this present value to time 0, we can simply just take the present value of time 0 of the present value of 10. Okay, so that just means discount the present value 10 years into the future by 1 plus R% to the 10th power, for example. Okay, so let's give you a little bit more intuition of what kind of contracts each of these terms refer to or can refer to. So in slide 19, I asked you what are some real-world examples of perpetuities, which could be delayed, growing, or both. So let me give you some examples here. A special case of a bond that pays coupons or interest forever is called a consul bond. So I don't think many developed nations issue consul bonds nowadays, but I know UK, for example, at some point in time have consul bonds. Of course, once the government buys back these consul bonds, they no longer exist, but at some point in time, these did exist in the hands of non-government institutions, and these bonds did pay coupon payments forever. Like if you literally held on to it in a trust or something, the government will pay coupon or interest on these bondholders. Okay, royalties is also some kind of perpetuity as well, as you can think of like music licenses, right? I don't know, it depends on which country, but typically if the intellectual property is broad enough, music and artists are paid interest or a fee so that people can use them year after year. So if you, for example, write a Christmas song and it becomes very popular, or a Chinese New Year song, if radios and TV shows decide to use it, they would have to pay you, a fee or royalties for them. So let me give you an example: music, technology, for patents, for example, that's another type of royalties or licenses, and they're essentially in perpetuity. Patents may expire, but there are ways to extend the life of patents. But in any case, this is just an example. We can get pretty close to infinite interest payments. All right. You can think of rent also as a perpetuity. Of course, this assumes that you as a household will continue to, for example, you may put this property in some trust, and if this trust exists indefinitely, then this trust can charge rent on this property essentially forever, right? So rents are also in some way a sort of perpetuity. Same thing as trusts or estates. So this is just like if you want to pass on your savings and your assets to your children and your children's children, you can put them in a trust, and rather than give all that assets to your offspring directly, you can just simply say, oh, this estate or asset pays out some sort of dividend, so long as it is not liquidated. Another example is subscription plans. Think about cell phones and utilities, right? So long as they have people using their network, or they are people occupying a certain area, from a corporation's perspective, they can interpret or model this cash flow as some sort of perpetuity, right? And lastly, university endowment. typically endowment have specific charters. They have to invest in certain assets and so forth, but they have to maintain some investment balance. So if they're only required to generate X amount of interest, and that endowment would therefore, you can think of it as a perpetuity if this university exists indefinitely, right? There are several universities that have existed, for 500 years, for example. So it's basically almost infinity. All right, so these are examples of perpetuities. Let's talk about annuities. What are some real-world examples of annuities? I think these are a little bit more realistic. So perpetuities, not that quite rare, I think, for the typical individual or household. But annuities, basically any type of bond can be thought of as an annuity. So car loans, obviously, you're borrowing money. So and for fixed payment, and you have to service that bond issuance every month, right? Same thing for mortgages. You again are issuing a bond, and basically the bank buys the bond or the mortgage from you, and you have to pay mortgage interest rate, right, on your mortgage, which is your principal. Student loans, another type of bond, right? Maybe not many of you have student loans, but if you went to a very expensive university abroad, you may have to take out a loan to pay your tuition. And so once you graduate, you have to start paying interest on those principal amount. Lottery winnings. So I don't know if lotteries are popular in Asia, but winners typically have a choice. They can either take a lump sum, which is typically lower than the amount that they actually won, or they can actually get the full amount, but they have to spread it out over a couple of years. And you can think of it as a type of annuity. All right, other types of annuities, child support and alimony. You can think of that as an outflow of cash to your ex-spouse, for example. And as I already mentioned, bonds, because they have coupon payments, right? Okay, so we'll talk about bonds next week. All right, so hopefully that's enough intuition and real-life examples for now. Now let's just get into the mathematics so that you can make your calculations easier on your exams and in real life as well. Okay, so in slide 21, I basically already gave you formulas to calculate standard perpetuities and standard growing perpetuities. So as you can see, the formula is much easier, much simpler than the one with an infinite sum, right? But I'm going to explain to you how it's derived. First, we have to acknowledge a property of the geometric series. So I'm not going to ask you to reiterate this proof. This is just for your education, okay? So in case you were curious how it's derived. Okay, so the property of the geometric, so let me write property of geometric series. The infinite sum as k equals 0 goes to sum of z to the k, can be rewritten as 1 minus z for z less than 1. All right, so this property can be rewritten as an infinite sum that starts at k equals 1 equal to z over 1 minus z. So I'll let you convince yourself that that must be true. And And then now we can substitute z for 1 over 1 plus r. And remember that the property of the geometric series simply assumes that the absolute value of the z is less than 1. And by assigning z equals 1 over 1 plus r, that's guaranteed to be less than 1 if r is positive. Okay? All right, so after that's true, then this infinite sum at k equals 0, plugging in 1 over 1 minus 1 plus r to the k is equal to 1 plus r over r. All right, so simply moving it forward, you should get, so that means that if we move it from k equals 1 we should get 1 over r. Okay, this assumes that the cash flow payment is 1, but we just replace it with c, right? And we should arrive at this formula here. So maybe I could be a little bit more explicit. So we have present value of c equals r, which is equal to the infinite sum n equals 1 to infinity. And we're summing c of 1 plus r n. And we can factor out the c. One over 1 plus r n. And this can be simplified into c times infinite sum of 1 over 1 plus r to the n minus 1. Okay, and this is equal to c 1 plus r over r minus r over r, and this will give us c over r. Okay, so that's how it's derived. So actually, ignore this. Yeah, so that's how it's derived. So once you have this, we have the following here, right? And that's how we arrive at c over r. Okay, so the growing perpetuity, let me derive it for you here as well. We have present value equals c over r minus g. So g is the growing term, the growing interest. So I can rewrite this more explicitly. This infinite sum starting at n equals 1, c times 1 plus g n minus 1 over 1 plus r over n. Then we can divide this minus 1, right? We can take it out explicitly. And then we're just left with n, the infinite sum of 1 plus g over 1 plus r n, and realize that we're going to assign this expression as z, right? This corresponds to this z here. So an assumption that you have to acknowledge from the growing perpetuity formula is that we are assuming that r is greater than g. Okay? If r is greater than g, then this 1 plus g divided by 1 plus r is going to be less than 1. All right? Otherwise, you're going to have a negative sign in the denominator, and that's not going to make any sense. All right, so once we have this expression, we can simplify it some more. 1 plus g times 1 plus g over 1 plus r divided by 1 minus 1 plus g plus 1 plus r. And you can reorganize the formulas, your expressions yourself, and you should arrive at c minus C divided by R minus G. Okay. All right, so I'm not going to ask you to memorize how it's derived. It's unnecessary. You just have to realize, you just have to kind of understand how they're derived. But I'm not going to ask you to give me the step-by-step derivation of it. Okay, so let's try to use these formulas in some questions. Sorry, so let me first go over the present value of annuities, and then regular annuities and growing annuities, and then we'll go to an example. Okay. So I'm going to just derive them here for you quickly. So let me explain to you how they're derived. For just the regular annuity expression, we will start out with the fixed sum of C divided by 1 plus RK, and it's equal to the infinite sum up to K minus the infinite sum of K plus N. Okay, so let me try to convince you that we can decompose this annuity into the difference between infinite sums. So if we look at this timeline here, our cash payment starts 1 year from today, but our annuity terminates at N, right? This is what we want to calculate, the present value of this cash flow interval. The first term, let's assign this first term as A and this second term as B. What the first term is actually giving us is the present value of from time 0 to infinity, right? This is our present value of A. For B, it's giving us the present value of cash flows that occur from N to infinity, right? This is B. And taking the difference between A and B will give us N. Okay, hopefully that's clear. And if that's so, we can simply rewrite this expression as C over R, which is what we derived in the previous slide, minus 1 over 1 plus R to the N times C over R. And simplifying this some more, we will arrive at our desired annuity formula. Okay. Same idea for the present value of a growing annuity. So I'm just going to write out the mathematics and then allow you to work through the algebra. So the present value of a growing annuity looks like the following in its really ugly form. And of course, the trick here is to split this annuity into differences of two infinite perpetuities. Sorry. This is C times 1 plus G to the K minus 1 divided by 1 plus r to the k. Okay, so once you work out the algebra and substitute the perpetuity formulas and annuity formulas we had from the previous slide, you arrive at this expression here. All right. In any case, it's good to know how it's derived, but I will not ask you to prove these formulas. Okay, but just be comfortable using them, so that it's second nature when you do the problem sets or when you do the exams. So let's go over some examples. So in slide 23, the example reads the following. You would like to endow a student fellowship each year starting next year. The fellowship will award one student $10,000 toward tuition. You would like the endowment to support the fellowship forever. The university earns 8% per year on its investments. How much do you need to donate to endow the fellowship? Okay, so again, it's easier to understand this question once you have a timeline written out. So that's what I'm going to do first. Let's write out the timeline. So it states that each year, starting next year, the fellowship will award one student $10,000 towards tuition, and you would like to do this forever. So if today is 0, starting 1 year from today, we will have to pay out $10K. 2 years from today, another $10K. 3 years, another $10K, all the way to infinity. All right, so how do we map these future values of 10K forever into the present value? We just have to use the perpetuity formula, right? The perpetuity formula tells us that the present value is simply the fixed payments every year starting next year, which is 10K, divided by the interest rate, which is 8% per year. Okay? And that will give us 125K. Right, so that's the amount you have to donate today so that you can have 10K forever. All right, extensions of this question. Now suppose you want the fellowship award to grow over time, right? It makes sense because costs of living may rise, rent may increase, food prices may increase, and so forth. And suppose next year you want the fellowship award to be $10,000 as usual, but after that you want the fellowship award to grow at a rate of 4% a year. How much do you need to donate to make this endowment possible? So if you read it through like I did, you realize that we're actually looking at a growing perpetuity, and we simply have to apply the growing perpetuity formula to find how much we need to donate to the endowment today to generate this growing perpetuity, or cash flow, outflow. Okay, so just to make things do this quickly, we know that we're just dividing the fixed cash flow, right? And then, but there's a growth rate of 8%. Sorry, interest rate of 8%, but the growth rate is at 4%, right? And once we calculate this, this is our R, and this is our G, right? Then we will have 250K that we have to donate today to make this possible. And just to make things clear, let me draw a timeline what this looks like. You have 10K the first year, but then you have 10K times 1 plus 4% all the way to infinity. All right, more examples. You are a 30-year-old. You are 30 years old today, and you plan on retiring at age 70. To maintain your lifestyle, you need to estimate. You estimate that you will need $250,000 a year for 20 years, starting on your 70th birthday. You have decided to save for retirement in an account that pays 5% interest. How much do you need to deposit today and cover your desired retired income? So this is kind of giving us an annuity and asking us how much we need to put in at some point in time so that it generates that amount of cash flow for that fixed period of time. So let's again write out the timeline to make things clear what we need to calculate. So we are going to, I'm 30 years old today, so 30 years is our time zero. And we want to start making, we need to start paying ourselves at age 70, so all the way to age 69, and then at 70 we will pay ourselves $250K. Okay, and we need to pay ourselves $250K every year all the way to age 89, right? This is for 20 years, right? Because we're starting at 70, so 89, and that will give us, yes, the following expression as a result. So there's two parts to this, right? There's a delayed annuity, right? Because it's starting sometime in the future, and there's no growing, so it's just a fixed payment of $250. So we're just going to use the delayed annuity formula. So our present value, therefore, is 1 over 1 plus r to the 39th, because it's 39 years between 30 and 69. Right? Because we have what we're trying to do here is trying to calculate the annuity at 69 years in the future, and then bring it back to 30 years, which is today. All right, so the delayed annuity is, or just the annuity is $250K divided by 5% times 1 minus 1 over 1 plus 5% to the 20th power, right, for 20 years. Yes? So just to reiterate, this 39 is our discounting back to today. And so this present formula has a value of 464K. All right. So an extension of this problem is, suppose now we want to make more than one deposit. So in the previous question, is only asking you to make one deposit today, and then you generate that amount of annuity payments sometime in the future. But suppose we allow the fact that we can invest over multiple periods of time. Can we essentially reshuffle our future cash flows to keep the price the same? Okay, so let me read the question. Suppose that instead of depositing a lump sum today, you are going to make an equal deposit at the end of every year until you retire. So that means that we're going to make some fixed payment starting at 31, 32, 33, all the way to 69. And after that, you still get the 250K. So you're giving yourself flexibility. You don't need that lump sum today. So the question is, how much do you need to deposit at the end of each year to cover your retirement income? So this is, again, very simple, because once we have the present value, we simply have to write out, the new annuity formula and just solve for that constant cash flow, right? So 464 is what we calculated in the previous slide, and now we want to we have 39 periods, so we just use the annuity formula here again, right? Minus 1 over 1 plus 5% to the 39th power. And you should get a, and we solve for C. And C is going to be equal to 27K. Right? And we have an interest rate of 5%. All right. So, more examples on slide 27 is about mortgages. So let me read the question. You have decided to buy a house for $1.5 million with an initial down payment of $500K. To finance the balance, you have negotiated a 30-year mortgage at an annual interest rate of 3%. Assuming that your mortgage calls for equal payments at the end of every year, and the interest rate is compounded annually, what is your annual payment? Okay, so we already have the present value, right? We need to finance a 27. We need to finance $1 million, right? We already have $500K as a down payment. We need to finance $1 million, and we need to calculate the annual payments we need to pay to service that initial principal of $1 million. So let's write out the present value, future value equation. $1 million. Again, the $1 million comes from the fact that it's worth $1.5 million, but we already have a down payment, and we're simply borrowing money. We're only borrowing $1 million, is what I'm saying. Okay, and we want to figure out how much we need to pay every year to service this initial principal. So that has to be equal to some annual payment C at an interest rate of 3% times 1 minus 1 over 1 plus 3% to the 30th, right, for 30 years. Okay, so this is just using the annuity formula. So C, therefore, is 51K. Okay, so just be comfortable with the equations or the formulas that I gave you. We went over basically 4 types of new formulas. One is perpetuity, right? And we talked about also an annuity. We derived each of these two special cases of the infinite cash flow formula. And we also talked about delayed perpetuities and annuities, and also what do you call it? Growing annuities and perpetuities, right? These are just minor modifications to the formula, but once you modify it, you can get reduced, simplified expressions that is manageable if you do it by hand or in your head. Okay, I won't ask you how to prove these formulas. You just need to be comfortable using them on your homeworks and exams. All right, so the last topic, I believe, in this set of slides is the net present value, and I kind of already hinted at what this is. Net present value is simply just adding up all the present values of all your cash outflows and cash inflows. So cash outflows just means it's a minus, cash inflows is a positive, and once you add it all up, that gives you the present value. Okay, so of course you don't have to so as I already said, NPV is simply the present value of the benefits, or the positive cash flow from some project, from some investment, blah blah blah, and minus the present value of the costs. These costs just means, to be as general as possible, just means outflow of cash. Okay, it can be expenses, cell phone bills, interest payments on bonds, on mortgages, whatever, rent. So once you have this time value of money, discounting, compounding framework, it's very easy to kind of break things down into its components and calculate the net present value, and then just simply add them all up at the end. Oops. Okay. So I believe, all right. So the last part of this class, this lecture, I will talk about interest rate conversions. Okay. So this is just a review. Please check the textbook for extensive discussion on interest rate conversions. I'm just simply giving you several examples of converting from different compounding frequencies to other compounding frequencies. But we won't get to continuous compounding, at least I don't think I will, but that requires additional mathematics that I can go into if somebody asks me about it. But for this class, simple fine discrete compounding is sufficient. Okay, so let's talk about an example of monthly compounding first. So in this example, you deposit $10,000 in a savings account that pays 6% interest per year, compounded monthly. Okay, so that's kind of the key important fact to take into consideration. What will be the balance of the account in 1 year, in 2 years, and n years? So how do we, given our annualized or annual percentage rate, interest rate, how do we compound this monthly? Okay, to arrive at our final present value. Okay, so this is more of a definition. So if you're given a per annum interest rate, to get the monthly interest rate, you simply take that number and divide it by 12. Okay, so if your savings account pays 6% per annum, but it's compounded monthly, you simply take that interest rate divided by 12 and compound that monthly, rather than taking the 6%. Okay, so for example, if I want to compound this for 1 year, 12 months, right? So 12 mo stands for 12 months. That's simply equal to $10,000, which is your initial deposit, times the compounding interest rate, which is 6% divided by 12 because it's monthly compounding. And then we compound it 12 times, which gives us 1 year. See, fairly simple. So an extension of this to a general n years, you simply multiply n times 12 months, which is going to give us $10,000 times 1 plus 6% divided by 12 to the 12 times nth power. Okay, so there is a special term for this 6% divided by 12. That's called the periodic rate. So the 6% is the annual percentage rate. If you divide it by 12, which is our compounding frequency, that is typically called the periodic rate. And this exponent here is will always be the number of periods compounding. Number of periods compounding. Okay. So I'm giving you examples because I think it's easier to understand how we do compounding and compounding conversions rather than give you formulas. Okay. But if you want to talk about the mathematics, just look in your textbook and it'll give you a full explanation of how the compounding formulas are derived by converting one compounding to another. All right, slide 32. Another example. You have decided to buy a house. So I think it's the same example, but now we're going to change our compounding. So you have decided to buy a house worth $1.5 million with an initial down payment of $500,000. To finance the balance, you have a negotiated 30-year mortgage at an annual interest rate of 3%. Now, assuming that your mortgage calls for equal payments at the end of every month, and interest rate is compounded monthly, what is your monthly payment? Okay, so this is a very minor modification of the annuity formula that we already saw in the previous example question. So let me just quickly write out the annuity formula, and then I'll explain the components. So it's very similar to the previous answer, but instead of dividing by 3%, we're dividing by 3% divided by 12, right? Because we're looking at monthly interest payments rather than an annual interest payments. So we have to similarly make the same modification in the rest of this annuity formula. So 3% divided by 12 and times 360, right? Because it's 12 times 30. 12 times 30 equals 360. Okay. And you just solve for PMT. So PMT is just my shorthand of writing payment, monthly payment. So solve for PMT. Okay. All right, interest rate conversions. So these are just industry practices. There's no real rhyme or reason logic behind this. This is just what they do in practice. So banks typically like to quote interest rates in annual terms, and they're typically called APR, annual percentage rates, right? And typically we cannot use APR to discount itself. We have to be able to we want the actual effective annual percentage rate, especially if this percentage, if the APR excludes compounding, right? So let me be more precise of what, how do we convert from APR to EAR, or effective annual rate. So the formula that's given your textbook should look like the following: 1 plus APR over N. Okay, so APR is the annual rate, but if there's compounding, then you should actually be using the EAR if you're doing annual stuff. Okay, so in other words, if you're talking about annual percentage rate, but it's compounded annually, APR and EAR are the same. But if it's an annual percentage rate, but there's different compounding frequency, then you have to make this conversion. So to be more precise, 1 plus EAR will include compounding interest, and APR doesn't. And N represents the number of compounding periods. Okay, so let's do an example of APR to EAR. In this example on slide 34, you have invested $10,000. You invest $10,000 at an APR of 10%. That's compounded semi-annually. Okay, so that means twice a year. What is the annual percentage rate that would generate the same amount of interest after 1 year using the APR, using the annual compounding? So what this question is asking you to do is solving the following expression. We have 1 plus EAR, right? That's annual compounding. That's equal to 1 plus 10%. Sorry, 1 plus 10% divided by 2, because semi-annual, compounded twice, and our EAR is 10.25%. Okay, so that's basically converting a semi-annual compounding interest rate to a annual compounding interest rate. And the last example on slide 35. Suppose you are in charge of pricing certificates of deposits, or CDs. So that just means you deposit some money and then you can't take out that money for a fixed amount of time without incurring some penalty. And suppose you're in charge of CDs for the Bank of Venice Beach, and you have to determine what APR to offer on a CD that features quarterly compounding. So that's something to keep note. So quarterly compounding just means 4 times a year. Okay, your boss tells you that the bank will take the proceeds of selling CDs and place them in an investment and earns EAR of 2%. Moreover, she wants the bank to net a profit of 25 basis points. Okay, so basis points, 1 basis point is just 0.01%. That's just terminology. In terms of EAR, what APR should you quote for the quarterly compounded CD? All right, so let's first figure out what the EAR outflow should be. Okay, so your boss tells you that the investment earns 2%, and you're going to pay out to your CD people who are interested in CDs at some percentage rate. So let's call that X. And so we're trying to figure out that amount, given that your boss specified a profit of 25 basis points. So that's just 0.25%. So our EAR outflow, so that just means the interest that we should provide for those that are interested in the CDs, is going to be equal to 1.75%. Okay. And our task, therefore, is to figure out what the APR should be, right? So let's go back to our EAR APR formula. So our 1 plus EAR should be equal to 1 plus APR divided by the number of compounding, which is 4 because it's quarterly compounding. And we take it to the 4th power because, again, 4 times compounding per year. We know our EAR, so substitute EAR here as 1.75%. And solving for APR, we get that it should be roughly 1.738%. Okay? So that's how you convert interest rates with different compounding frequencies. Yes, so the next slide asks to solve for APR, which I did. All right, so that's it for this week's lecture. So let me go over what I talked about in this set of lecture slides. So I tried to motivate what we wanted to do in this class, which is find a framework to basically price different cash flows that occurs at different points in time and also have different risk. We haven't gone to the point of talking about risk yet, but the idea here is that we want to eventually build a framework to flexibly price anything by first given cash flows, right? So what I started talking about was how to map from present value to future value, and I did this through interest rates. And as I discussed extensively through this lecture, interest rates, you should think of it as the amount of money that you're willing to, the interest rate that you're willing to take on to part with your money today. Okay, or alternatively, you can think of it as the opportunity cost of using that money for something. Okay, once you have that interest rate, it's very easy to move from present value to future value, right? You simply compound the present value all the way to the future date period to get the future value. If you want to move from future value back to present value, that's also very simple. You simply divide by 1 plus the discount rate or the interest rate. But using this framework, it's then very easy to compare the financial value, right, across multiple projects or multiple set of cash flows, as long as we map them into the one sit in the same horizon. We typically move our cash flows to the present value. So once we map everything to the present value, it should be very easy to decide which one generates more value. Okay, the last two parts, the last two big topics I talked about in this set of lecture, it's more technical. I gave you some formulas that simplified the cash flow infinite sum into special cases, in which we have a very simple formula for standard perpetuity and standard annuity, right? And we also allowed a growing cash flow as well, right? A growth rate. You don't need to know how to prove these formulas. You just have to be comfortable using them for your homework and in your exams. And lastly, we talked about interest rate conversions with different compounding frequency. Okay. So again, the last two parts, just technical review. If you're still not comfortable with it, you can come and ask me or refer to the textbook. So that's it for today. Next week, I will start talking about bonds and interest rates. And yeah, so that's it for now. Have a nice day.